AI chip stocks are under pressure after reports suggesting the Biden administration is considering stricter regulations on exporting high-grade American semiconductor tech to China. We'll examine the potential effect of these regulations on the major players in the AI chip market.
Time for some trending tickers. Taiwan Semiconductor beating expectations in its latest report and raising its full-year revenue outlook, fueled by confidence in AI demand. The chipmaker's CEO saying on an earnings call, quote, "This time, AI demand is more real than 2 or 3 years ago." This comes just a day after reports of potentially tighter trade restrictions from the U.S. send chip stocks lower. We're seeing a bit of a clawback there of those losses that we had seen in yesterday's session. Again, you're looking at gains of just about 3%. But digging into this report, lots of strength. They recorded 40% sales growth here for the quarter, raising their full-year growth outlook, revenue growth outlook, to be in the above the mid 20% range. We mentioned the commentary from the CEO in regards to AI. Well, the company actually saw high-performance computing, including AI, contributing to 52% of TSMC's revenue here. And that is significant because that marks the first time that has happened, that it's accounted for more than half of the revenue there going forward. So, Maddie, that really speaks to the insatiable demand that we have seen for AI, this willingness, this CapEx willingness here from companies to spend on their AI efforts. And a name like Taiwan Semiconductor clearly reaping the benefits of that.
Absolutely. I think it's interesting, to take a look at beyond the stats that you mentioned for TSMC, and obviously the growth that TSMC has, contributing 90% of the world's most advanced chips. When you get a report like this with such strong earnings, that's going to move the companies that are utilizing and being the customers of TSMC. So that is why we are seeing a turnaround in some of these chips names in the pre-market trade here. You're looking at shares of NVIDIA moving strongly to the upside, up over 3% in the pre-market here. I also mentioned to you, Sean, I was surprised at the degree of the upside that we were seeing in Intel. That is one of the companies that's going to be a beneficiary of the commentary that we saw both from President Biden and former President Trump about bringing production stateside. This is a company that already has the chokehold really on U.S. production. Meantime, you've got TSMC working on building plants in Arizona. That's going to cost them over $65 billion. But that takes time. And that is part of the broader discussion we've been having about bringing production stateside and the expense and time that that's going to take.
Wall Street facing increasing turbulence this week, particularly with big cap tech stocks. The Nasdaq sliding again after its worst day since 2022, marking a continuation of the shift away from tech. With this move out of tech shares, does it leave an opportunity on the table, maybe worth taking for investors? We're looking at how to navigate the big picture with the Yahoo Finance playbook. Spear Invest founder and CIO Ivana Delevska joins us now. She is a tech investor. So Ivana, as we are seeing this pullback here, does it make sense for people to add to positions? And if so, how should they be thinking about doing that?
Thanks for having me, Julie. So we do still see a lot of opportunities in the data center value chain. And I think it makes a lot of sense to add to that on this pullback. This has been a pretty meaningful pullback on what is a headline risk, right, that you always have in the sector. And the stocks are down more than 10% from the levels. So I think it's a very good time for investors to take a look at the data center value chain.
And when you say data center value chain, Ivana, what name specifically are you talking about?
So the core of the data center value chains would be opportunities inside the rack. So would be processors like NVIDIA, AMD. But then the opportunity is broader than that, right? It's basically the entire infrastructure build out around data centers. So there's opportunities in thermal management, power management, even at the utilities level, because energy is one of the big constraints that we see. So it's really going to be across the board.
Ivana, earlier today, I talked to the Blackstone president and chief operating officer, Jonathan Gray. Blackstone, a huge investor in data centers. And I asked him sort of how he's thinking about a little bit of the skepticism that's been out there right now. And he talked to me about that investment. Listen to what he had to say.
We think there are going to be a lot of changes. Some of that may take a bit of time. But our focus has really been on building the backbone, the infrastructure of the 21st century, which is the data centers and the power that goes with it. I think this will come. What the profitability will be, which applications will win, I think that is uncertain. But I think the path here towards more AI, more compute power, and therefore more infrastructure needed is the way to go.
So you were just talking about the infrastructure as well, but it does seem like at least some of this sell-off, while yes, it was spurred by concerns over China, also has to do with real questions about not the infrastructure, but like what you do with it, right? The software, the end users. How are you thinking about those questions?
That's right, Julie. So that's really the main question here is, are there end applications that are useful, that are justifying all of this investment that is going in place? And seemingly, if you look at what's come out, apart from ChatGPT, at first sight, there doesn't seem to be a ton of large multi-billion-dollar applications. But what I think the market is missing is that some of the early investors like Meta, like Google, they're investing significant dollars into this. They're doing it to defend their current business, right? So if Google doesn't keep up with ChatGPT, their entire business is under attack. Similar with Meta, they were able to really do a good job with Reels and Instagram and reinvigorate their business. So just these two applications of recommenders are just huge investments and require significant investment going forward to keep up with it. And then as we go forward, it's going to take 2 to 3 years to see real applications come through. We are already seeing it on the early side with customer service and productivity improvement tools that are really leveraging the large language models. But the next level, the next layer of opportunity will be in the physical, like robotics, autonomous driving, and that's going to take a little bit longer to play out. Nevertheless, you do need to make the investments today in compute to be able to advance these applications even a little bit.
Ivana, another space I know you monitor closely is the cybersecurity sector, Ivana. I'm interested in what names you like here at these levels. And also in that same theme, Ivana, any thoughts on these reports we're seeing of a potential Alphabet Wiz deal?
Yeah, absolutely. We really like the cybersecurity space. I think it got caught in the software sell-off, while the fundamentals for cybersecurity are significantly improving. So we're seeing a lot of opportunities there today. We like Zscaler, we like Datadog, we like many companies, and we disclose our holdings on our website just for your viewers. On the Wiz deal, I think it would, at first sight, it looked like a low probability deal, but the more we dug into it, it makes a lot of strategic sense for Google. Even though Wiz is one of those companies, they're very rapidly growing. They just raised their new round. It didn't seem like they would need to be doing an acquisition or they would need to sell themselves. But the more we looked into it, it does seem like a very good strategic fit. The price tag that they're paying is pretty significant and has pretty positive implications for the rest of cybersecurity, both for the companies that are next-gen leaders with similar growth profiles to Wiz, as well as smaller cap players like SentinelOne, for example, that is in that same boat, very high growth, but hasn't been able to really get a good valuation in the public markets.
Ivana, always great to have you on the show. Thanks for joining us. Leading the NASDAQ slide today, semiconductor stocks. The chip sell-off coming amid reports the Biden administration is considering even stiffer regulations on exports of high-grade American semiconductor technology to China. And joining us now is Matt Bryson, Wedbush Securities Senior Vice President of Equity Research. Matt, it's great to see you. I actually wanted to start, Matt, on these comments that got a lot of attention that former President Trump made in this interview with Bloomberg Businessweek. Matt, I know you saw it, but he said Taiwan took our chip business from us. I mean, how stupid are we? They took all of our chip business. They're immensely wealthy. The reaction, Matt, and some of the names you cover, I know you covered Taiwan Semi. It's down, Matt, almost 8% here. What's interesting for investors to think about is, we are building out our domestic chip manufacturing in this country. We're putting a lot of money and time and effort into it. But it's such an enormous project, Matt. I mean, there are analysts who say if you're really going to do that, it's not just money. You have to think about your education policies, your immigration policies. It's enormous. For now, we are very much, and listen, you know the company, you know the space. It seems that we're still very much dependent on some of these names getting hit today, like Taiwan Semi.
Yeah, no, there's no way you can move away from Taiwan Semi anytime in the near future. When you think about iPhones, right? The core processor of every iPhone comes out of Taiwan Semi. Every AMD chip, so a lot of our server chips, a lot of our PC chips, they all come out of Taiwan Semi. NVIDIA, so all their AI chips are fabbed at Taiwan Semi. You can go down the list, Qualcomm. So again, every smartphone modem, because MediaTek as well is fabbed at Taiwan Semi. And so, no, we can't live without Taiwan Semiconductor. And when you think about how much money Taiwan Semi has been spending on equipment, 30, 40 billion a year in terms of CapEx, you can't replace it even if you can duplicate their technology. And so, no, Taiwan Semi is not going anywhere anytime soon.
Matt, so given that, do you think that the sell-off that we're seeing in this group today is justified? Do you think that people should be taking these threats seriously, or because of what you're saying, like Taiwan Semi is not going anywhere, we need them, or the U.S.-based chip makers need them, that there isn't a real threat that, you know, that any U.S. administration would let there be threats to the island?
I mean, I certainly would say that there are more likely losers, if you will, from shifts in Taiwan in U.S. policy towards China. So not necessarily commenting on ex-President Trump's remarks, but when you look at what the U.S. is doing in terms of restricting capital equipment sales into China, if they are successful, certainly that would weigh on ASML, that would weigh on some of the other capital equipment names, Tokyo Electron, and that's something to think about. Chinese policy, if those restrictions go into place, China's been far less aggressive in blocking or affecting U.S. companies. So maybe they'll take that line again, and so it's not so much of an implication. But certainly, companies that export to China, if China takes a harder stance and starts banning imports, that's something to think about. But in terms of again, things shifting immensely for someone like NVIDIA, where China is a relatively small portion of their revenue because there's already such significant restrictions in place. Thinking about moving away from Taiwan Semi anytime in the next 2 to 3 years, I just don't think there's any real implications, right? There's no alternative to Taiwan Semi. There's no strong alternative to NVIDIA at this point.
And Matt, another name in your coverage universe, I want to get your thoughts on Intel. And it's interesting, Matt, because it's kind of bucking the trend here today. It's actually up about 1%. I'm not sure what to make of that, Matt. Maybe some investors are thinking, well, CEO Pat Gelsinger, he's actually building those chip plants here in the U.S., so he's on the right side of where a lot of American politicians are at, just ideologically. But that name, you still have a neutral on, Matt?
Yeah, I have a neutral. The neutral comes down to, I think at the end of the day, whether Intel is successful or not depends on its ability to get its chip manufacturing back to where it used to be. Right, 5 years ago, Intel was the leading company in terms of chip technology, in terms of manufacturing. Now they're not, and I'm still a little bit unclear on how that path progresses. Hence the neutral. But with Intel today, I think certainly it's Intel being viewed as an alternative to Taiwan manufacturing. The other stock in my coverage that's up today is Global Foundries. I would say for Intel, it's a bit of a mixed bag. Certainly, if there's a push towards supporting U.S. manufacturing, that benefits Intel, and then it gives them more resources to right the ship on the manufacturing side to get to Pat Gelsinger's vision, if you will. But at the same time, they also ship a lot of server and PC compute to China. So if you go down the path of further China restrictions, could they be affected? Maybe. Global Foundries, it's an easier story, right? They are an alternative to Taiwan Semi, to UMC for more mature processes. And so if you see a risk-off shift in terms of sourcing semiconductors, sourcing foundry capability, Global Foundries is an alternative to that Taiwan production.
Well, I guess that helps explain why the shares are higher today and bucking that downtrend. Matt, thanks so much. Really helpful stuff.
Thank you.
You mentioned the bank earnings, usually the signal of the start of earnings season. We have Netflix tomorrow, one of the first big tech players reporting. How do you think these Mag 7 names, like an NVIDIA, for example, will perform this earnings season? Do you think it can sustain the recent run-up that we've seen?
So we feel that these companies should be a core position in the portfolio, no doubt about that, right? And potentially their earnings will be good as well, but it's all about expectations. So again, in the short term, for the retail investor, very difficult to predict. But the problem right now is that a lot of people, the concentration risk in the market, 20%, more than 20% of the S&P 500 is in 3 stocks. And people don't want to sell these stocks. They want to hold on to them forever. Book some profits, no individual stock should be more than 5% of the portfolio, and invest in other areas of the market to protect yourselves.
Let's talk about a controversial Mag 7 stock, that's Tesla. You actually own Tesla stock. We've seen this massive rally, but it's clearly a volatile name. There seems to be some optimism, though, over robo-taxis, AI automation. Where do you see Tesla going in the long term?
I think we like Tesla. We have it in clients' portfolios, and we think in the long term it's going to do well. But it is a volatile stock, so you should limit your exposure and be exposed to it in a very diversified way. But we think there's a lot of exciting things in the future for Tesla, including the robo-taxi that you mentioned. So it is a core position in our portfolio.
Diversification, always key. Adil Zaman, thank you so much for joining us today. Appreciate it.
Thank you.
The chip sector under pressure this morning after former President Trump saying Taiwan should pay the U.S. for defense during an interview, but also really what's driving today's action is President Biden said to be considering cracking down on chip makers who ship to China. That's according to a report out from Bloomberg. To discuss what all this means here for the broader market, we want to bring in Seema Shah, Principal Asset Management Chief Global Strategist. Seema, it's great to have you. So we have seen this rotation out of some of those larger cap tech names over the last couple of trading sessions, and then pairing that with this morning's news about reports of a broader crackdown here potentially from the Biden administration. I'm curious how you see that playing out in the market, potentially if we do see that go into place in the coming weeks.
Thanks for having me on. So, yeah, this is not unexpected. I think everyone has been anticipating that as you see this continuation of US-China tensions, that unfortunately some of these chip makers' technology almost falls right into the spotlight. On top of that, of course, you've got very, very, very rich valuations for these companies. So inevitably, there's going to be some kind of consideration from investors about how this proceeds. Now, we continue to like those mega cap technology names, a lot of the software chip makers, but probably would not be adding exposure at this point and really looking across a broad portfolio to really think about diversification. Where else around the world will do well in that kind of trade tariff environment, and also which are the parts of the market which are less expensively valued.
Well, Seema, I feel like you're talking about some of the movement we've seen in small caps and that rotation that has really been cemented over the past week or so, particularly in the Russell. What is the catalyst for the movement that we are seeing in small caps right now? Is it the valuation picture? Is it the geopolitical tensions? Is it Trump's VP pick, who's typically been favorable to smaller businesses? What do you think?
So I think there's a couple of things at play. The valuation story, I think, has been around for a while. It's just we've been looking for that fundamental shift, which can prompt people to start increasing their exposure. Now, you've had, as you said, you mentioned a couple of them. There's the Trump trade with this idea that actually, if you're more domestically focused, or if the U.S. economy is going to be benefiting, then it's the small cap companies which have a greater domestic revenue exposure than some of the large cap. But also it's about rate cuts. And we can see that it really coincided with that soft CPI inflation print last Thursday, when you did see that first very significant reversal. From here, though, I don't think it's entirely clear cut, because for small cap, not only do you have to have rate cuts, you have to have several of them, because small cap have such a significant part of their debt as floating rate, but also you need to have a solid growth outlook. So on that basis, for this to continue, it needs to be that the Fed cuts rates in time to ward off a further economic deterioration. So I think it's still early days to see if this is going to be sustained, or if it's just something which can go on for a month or two.
So, Seema, how are you positioned just given that uncertainty? Are you betting that this trade does have legs, or is it smart to maybe hedge this position at this point?
So we continue to have a greater exposure to the large cap companies. There's a number of reasons for that. I mean, I think we're going into a bit of an economic moderation. We don't think a recession is on the way, but that economic moderation probably means that you still want to have companies which are high quality, high liquidity, and also from a secular perspective, we still consider those companies as at the forefront of a lot of the productivity and growth advances over the coming future. So those are the areas that we're looking at, but we're also starting to think about where internationally, outside of the US, can fare well over the next 6 months to a year.
Well, let's talk about that, because I know in your notes you sent over to us as well, you talk a lot about global economic growth, and I do want to get your take on the potential risks to that within this election cycle. Former President Trump telling Bloomberg that we have a currency problem and talking about wanting to shift the 75% of non-farm payroll jobs that we have in services over to manufacturing roles, which would be a very big shift for our economy. If Trump is able to move the needle on that, and if his concerns about currency do get cemented into some sort of policy action, what could that mean for financial markets?
So it's a really good question. I think this is something that everyone is really focusing on at the moment. So if you were to see this increase in tariffs, concerns about, or actually let's start with the tariffs idea. Really, the US is the economy which really benefits the most. It's the rest of the world that would struggle on a relative basis. Within that scenario, we point India and Japan as the two countries which are a little bit outside of some of that spotlight. So we continue to actually like those economies. Latin America segments of it can do well. Europe is a little bit more in a slightly tougher position, because not only is it very much exposed to some of those tariffs and the China economic weakness, but also within a geopolitical perspective with regards to spending on NATO, defense spending, I think there are some concerns there. For the US, though, if there were to be concerns about the currency, and there was maybe a push to have a weaker dollar, that's actually good news for emerging markets. So it's fairly balanced. I think China is probably the area that we would be the most cautious of in that scenario.
All right, Seema, thank you so much for joining us. We really appreciate it. That was Seema Shah, Principal Asset Management Chief Global Strategist.